Good afternoon. It is Friday, which means it's time for risk and rewards, and it's not yet afternoon, but it feels like it because it feels like it's been about 3 years. I'm with John Authers. I'm Lisa Abramowicz, and this week's data really raised a question. It was really bifurcated. Inflation running hot, some of the economic momentum seeming to wane, a lot of noise because of Omicron. But does all of this make it more or less likely for the Federal Reserve to tighten policy, John?
On balance, I think it makes it slightly more likely because they really do have to do something about inflation. That is, they have a dual mandate rather than most central banks around the world solely looking after inflation. But if you're a central bank and it looks as though inflation might be getting out of hand, inflation psychology might be coming out of the bottle, you have to deal with that. The other point that you were making was that inflation, to some extent, and we've seen this in quite a bit of the data that we've just had the last couple of days, economies do self-right themselves to a fairly considerable extent. Once in prices begin to rise, you do see some effect on demand, and that's already happening. It would appear from the latest numbers, particularly the Michigan sentiment numbers. And that implies that inflation is an evil in itself that will ultimately hurt growth if you don't nip it in the bud. So I'm going to say it probably strengthens the hands of the hawks at the Fed, but I also agree that it's a fascinating and difficult question.
We also have the sort of thankless job of trying to give a narrative to a bunch of data points that are very noisy. And then people say, oh, you're just trying to create a narrative. And we're saying, yeah, that's basically our jobs. But, you know, this narrative is coming clear with each consecutive report. And I want to read a line from this latest University of Michigan sentiment survey, which came in weaker than people expected. And it showed that the consumers surveyed, the people surveyed, expect an inflation rate of 4.9% this year, compared to the income gain of 2.1%. So if you think about the real incomes, I was really struck by that with the CPI data, the real income. People are actually seeing the biggest negative real income growth, meaning your wages are basically going down on an inflation adjusted basis. Going back to beyond the financial crisis, I mean, we're seeing levels that are really quite negative. It's not keeping pace. And on one hand, you've got some people worried about a wage spiral, and other people are saying, this is actually a really bad sign because people are going to spend less and people are going to do less. And it's actually going to end up in a slower economy at the end of the day.
Yes, and add on to all that, obviously, the politics of the situation that you can argue about whether people want gridlock or not, but it's very, very bad news for the sitting president that people are obviously not very happy at all if they're expecting to get that kind of a cut to their living standards this year, and there are elections at the end of it. So the chance of real clarity in a policy response gets less as well. Yeah, it's a very worrying situation. I think the other thing I would like to throw in, one of the things that I found very useful or learned to use far more in the last few months as we've all reacquainted ourselves with inflation dynamics, is the Atlanta Fed's wage tracker data, which is very interesting, very granular, using census data. And the worst paid people, the people in the first quartile, are getting wage rises exceeding the gains for the best paid quartile by the most since they've started counting this in over 20 years. The wage gains are going up, but they're generally going up most for the people who are still very unhappy because they're paid very little, which is a toxic combination that I'm glad I'm not a politician to have to try to sort out.
Yeah, especially after bank earnings, given the fact that you're seeing bonuses go up so significantly. And you're seeing the likes of JP Morgan come out today and talk about how much compensation has to go up because they have to retain talent. How does this sort of read into this whole discussion, especially as Jamie Dimon's saying he's seeing inflation at the fastest pace going back throughout his entire career, let alone lifetime, and that includes the 1970s. I don't know if he meant to do that, but I'm looking at this and I'm wondering, Lindsay Piegza this week of Stifel Financial, the chief economist, said that she thinks that we are entering a kind of wage spiral dynamic where people are seeing their real incomes go down significantly. So they're going and they're demanding more compensation, only to see those companies turn around and charge more. And it becomes a sort of toxic cycle. And I don't know if that's, economists speak to say why we shouldn't get wage increases, or if this is something that's a true dynamic that's in the economy right now.
Well, there's two ways of economy speak, both of which become very political very quickly. One is people shouldn't be getting wage raises. The other is capitalists should be taking less in profits and not passing on the prices. There are good left and right wing arguments for how companies should behave here, and there are victories for both capital and labor that could worsen the inflation problem. I think I should have thought to do this before we started streaming. I haven't done a Google Trends check on Civil War in a while. The amount of references to Civil War, the amount of serious,
a real downtrend here.
Yes, I mean it's an escape. It's an escape for Britain from back home, where the Prime Minister is having to apologise for holding a party while the Queen was in mourning, which was the most absurdly British story ever. Going back to Henry VIII's 6 wives, that's about as British as it gets. But plainly, the mood in this country where we are now is toxic. That adds to that sense of conflict. That adds to the word populist can be used a little too easily and a little too insultingly, but the Trump administration was populist in some ways, and the Biden administration has been populist in some ways, but not in others. And people will notice that banks are still doing rather well, even though you would think, even though there's rather a large majority in the country that wants to rein them in. Where that leaves us for economic policy is the risk that things are going to get very, very strange and very hard to call for quite a while.
It's talking about hard to call. This week feels like a muddle. Is there anything that really stood out to you as being illuminating or game changing? I mean, we got bank earnings. We know that people are getting paid more. We know loan growth is still an issue, but everything is noisy because of Omicron. Everything is noisy for a whole host of reasons. And it seems like the story has just gotten muddier, not clearer.
Yes, that's not what either of us is paid to do. But yes,
no,
guys,
I'm supposed to give some massive conviction, and I'm not at all.
Yes, we're less clear about where things are now than we were a week ago after all this new information. I guess in terms of market responses to data, there's two levels. We're taking a constant sort of radiograms of the economy, or government statisticians are. And then we look at the market response to it, because the market is often a truth teller. If there was one thing, I'm not saying I fully understand or grasp why, but on Wednesday we had inflation numbers which were unquestionably bad, but also unquestionably no worse than had reasonably been expected. And you had a remarkably quiet, the bond market's been very, very churning and volatile. That was the quietest day the bond market has had for a while, was the day CPI came out. And it was the worst day for the dollar in something like 8 months. The dollar fell, on a broad basis, the more than it did on any day but one in the whole of 2021. So something is giving there. The foreign exchange market, my tentative guess, because obviously this is the most liquid market there is. Any number of people had any number of reasons for buying and selling dollars, but my tentative guess is that there is a belief that the bond market is right, that bond yields aren't going to go up that much in the future, but there is going to be inflation. And if you have inflation without large yields to protect a currency, that will weaken the currency. So that's my best guess, is that the foreign exchange market thinks the Fed is ultimately going to make a dovish mistake and not go far enough and let inflation out of the bottle. But that's not supported by the bond market.
It also, though, it raises conflict with the fact that real yields became more negative. Actually, the other way around, became less negative. So you actually saw them rise.
Yes, and real yields have so a lot of the bond market moves have been corrected out, or waggled back to roughly where they started. The move that seems to be standing at this point is that real yields are I mean, they're still incredibly negative, obviously, less than minus 7.7%, but they are back at a high for, again, since last summer. So but that's not helping the dollar. The dollar appears to have taken quite a sharp turn for the worse in the last few weeks.
We caught up with Jane Foley of Rabobank, and she suggested that it was a positioning squeeze, and that a lot of people were long the dollar heading into the year, and they're closing out some of the derivative positions, and so that's the reason why you're seeing them come off, and that at a certain point it will go back to a strengthening dollar kind of direction. But you're right, it's really hard to know what that is. I will say there's one undertold story of the week, and it's a confluence of issues around Russia and Ukraine and Kazakhstan, actually.
Yes.
I thought that the story around Kazakhstan and how much the rebellion kind of threatened the uranium supplies of the world, because this is the Saudi Arabia of uranium, and it supplies about 40% of the world's uranium. And this idea that, the rearranging of the power around green energy, and then the idea that the political backdrop in the United States has it that it's really hard for Vladimir Putin and President Biden to have any kind of real discussions, because what do you do with Nord Stream 2? What do you do with, the backdrop of oil prices being where they are? And you're seeing these dynamics come to a head where the tensions are rising, and it seems like a given that Russia's going to invade Ukraine. And I just am trying to figure out how this affects markets, considering the oil ramifications in a backdrop of inflation that seems to be the main political issue, if not economic issue globally.
Okay, I agree. I think some of the market action we saw yesterday, which was a true risk off day, bond yields down, stocks down, probably was driven by Vladimir Putin. But again, any number of different people did things for different reasons. But I think that it's still remarkable how little what on the face of it is a resumption of the Cold War is getting in the way of attention. It's not something that naturally comes up in conversation. The downside risk is obvious. If the brinkmanship doesn't work and Putin does go through with a Ukrainian invasion, part of the reason people are calm is obviously American troops are not going to go in to fight. People are not going to use nuclear weapons over this, etc. But if that happens, there is no choice but to turn Russia into as much of an international pariah in trade terms as Iran.
Right.
And it has an awful lot of natural resources that will hurt Russia a lot, and it will hurt America a lot, and it arguably will hurt Europe even more than either the US or Russia. That's the big downside risk that's there. I think the other thing to mention, Kazakhstan appears almost to be strengthening Putin's hand at the moment. There is again this sense that, but it's not just uranium. If you look at the unusual metals like cobalt or whatever that go into batteries and where they're found,
lithium.
Yes, they're in Chile, and which has just moved to the left, and Bolivia, and Peru, and Zaire, Democratic Republic of Congo. There are some very strange places that suddenly become, or countries that have unclear relationship with the West, that suddenly take a much greater hold, and that is very concerning, and it's very difficult to see how you express it in the market.
Well, one thing that I was speaking with a strategist this week who is saying that not only just sticking on the Ukraine and the Kazakhstan issue, that these are the countries that border with both Russia and China. And China's been moving in and collaborating with Russia in order to secure some of these renewable energy sources. And so they're deeply engaged. I'm just saying, from a market's perspective, how this feeds into the ability to reduce prices of that materials at a time when inflation is a big concern. And frankly, the data that we got that was, just as hot as people expected, actually included a bigger than expected drop from gas, right? So that component actually declined in December. What happens if that goes back up in tandem with higher wages, in tandem with higher rents, I mean, you start to sort of figure out how this could be a risk-off environment at a pretty delicate moment. So, I mean, these are just some of the outlier risks that I'm watching heading into next.
Okay, can I very quickly, because I think we're out of time, but yeah, I completely agree with that. That there is definitely an upside risk to inflation, which is very dramatically. The oil price shocks of the 70s were deflationary in the sense that they instantly hit, they displaced other stuff and they hurt economic growth directly. That is the risk that is there at the moment. Very reasonably, the base case scenario is that inflation is almost at the top, will continue to rise a little bit further for base effects reasons and supply chain reasons, and will then fall gradually, and everything depends on how much it falls towards the end of the year. And there is a possibility in this that will go radically wrong, that we've got yet more rises, and until that's out of the equation, that's very problematic.
I think it's a terrific point. And on that very happy note, happy Friday. And that is your Gloom and Doom report for the week. In all seriousness, John, it's always a pleasure. Have a wonderful weekend.